Good evening everyone, and welcome to today's Market Watch. To put it simply, we saw a day of divergence and consolidation. The indices didn't pick a clear direction, but beneath the surface, capital rotated with brutal intensity. Let's start with the key numbers. The VIX closed at 16.29, a relatively low level. The 10-year Treasury yield ended at 4.48. The dollar index DXY broke above the 99 mark, settling at 99.22. Spot gold finished at $4,486.80 an ounce. Bitcoin was trading around $73,778, and WTI crude oil settled at $89.57 a barrel. The signals today were deeply contradictory. On one hand, the VIX was falling, suggesting a lack of panic. On the other hand, the dollar was strengthening, while commodities and cryptocurrencies were declining. This tells us that bulls and bears have reached a fragile equilibrium at the index level, but the battle within asset classes is fierce. So where did the money go? It flowed into cash and the dollar, and into a few specific growth stocks sensitive to long-term interest rates. This was not a broad risk-on or risk-off move. It was a precise, defensive migration. Let's walk through the day's path. The Asian session set a weak tone. Major Chinese indices fell, led by heavyweight stocks. Only the Chi-Next index managed to hold flat, suggesting capital was clustering around a few growth themes in a weak environment, but this was not enough to reverse the overall pessimism. The European session likely extended this cautious sentiment. When the US market opened, it did not follow Asia lower, nor did it stage a strong rebound. Instead, it showed extreme divergence. Growth stocks and large caps diverged. Risky assets and safe haven assets diverged. Market sentiment was torn apart by complex macro forces. The clearest macro signal today came from the dollar index. Its decisive strength represents tightening global liquidity and rising safe haven demand. The biggest drags were cryptocurrencies and crude oil. Both fell sharply despite potential positive catalysts. Bitcoin declined even as the U.S. House passed a digital asset market structure bill. Crude oil fell despite OPEC Plus maintaining production cuts. This is the most direct evidence of declining risk appetite. I need to be honest here and admit my mistakes. I had been bullish for the past 2 days, but the market traded in a way that completely contradicted my expectations of a broad tech-led rally. I made several errors. First, I overestimated market risk appetite. The VIX drop lulled me into complacency, but the real signal was capital fleeing crypto and oil. Second, I underestimated the dollar's suppressing power. The DXY breaking above 99 is a direct hit to all risk assets. Third, I wrongly assumed that capital inflows into AI and semiconductors would continue. Instead, money flowed out of names like Nvidia and into oversold growth stocks. More importantly, a new structural signal emerged today. We saw a sharp divergence between a falling VIX and a rising DXY. The market lacks fear on one hand, but is buying dollars for safety on the other. This calm panic state is highly unstable and suggests a sudden volatility spike could be coming. For Asian markets tomorrow, this means significant uncertainty. Falling U.S. Treasury yields are positive for tech and growth stocks, but a strong dollar will pressure the renminbi and could trigger foreign capital outflows. So we may see intensified divergence within China's A-share market. Tech and growth stocks could be relatively resilient, while blue-chip heavyweights will face pressure. For Asian markets, avoid directional bets on indices. Instead, adopt a hedge strategy of going long growth and short cyclicals. Let me give you clear conclusions. First, the capital theme is clear. Money is avoiding high-risk assets and flowing back to the dollar. This defensive theme has been in place for over 2 days. Second, watch tomorrow's U.S. initial jobless claims closely. If the number significantly exceeds expectations, market volatility could spike dramatically. Third, based on current analysis, we maintain a cautious to bearish view. As long as the dollar stays above 99, continue with a hedge strategy. Focus on long positions in interest rate sensitive growth stocks, and short positions in cyclical commodities or related ETFs. The market is at a dangerous equilibrium point. All investors must manage their risk carefully.